Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feed and gregschnell.com for more information. Thank you. Lots going on here. We've got a nice big bull market rally going. Hopefully, you've been participating in it. We have almost every sector hitting new highs. Recently. We're going to work through the sectors today. I want to go through that, and I also want to follow up on oil. So it's about 60 days. It was actually September 21st that the Saudi oil strikes hit, and or the drone attack on the Saudi oil strike, or on the Saudi facility. So I want to cover that off. I'm probably more interested than most of the commentators in oil, but the reason I want to cover it off so specifically is that there was anywhere from a 2 million barrel a day hit to 5.7 million barrels per day. And if you just do the math on that, it's 47 trading days since then, but it's about 65 calendar days since then. Anyway, real rough, that at 2 million barrels a day off the market, that would be 130 million barrels now that we haven't created. And if it was the 5 million barrels a day, obviously that was 300 million barrels that hasn't been produced. So dramatically big numbers, and yet the market still seems relatively resilient. So that's what we're going to cover off today, and hopefully you'll find lots to interest you. I'm going to try and work through the sector review first of all, and give you some ideas about that. And if we get a minute, we're going to jump into healthcare, and if that doesn't happen, we'll probably handle that next week. On the back of the cryptocurrency special for next week. So anyway, stay with me for that. Okay, so first of all, here's the stock market over the last month, and roughly October 15th was when JP Morgan reported earnings, and that kind of started the rally. And we've been going up pretty much since then. I think what is really interesting is that consumer discretionary has underperformed even the S&P, so it hasn't participated in the rally at all. Commercial services has not participated that much. Tech has been the second best performer, but industrials are now fifth or fourth out of the group. And here's healthcare, really booming, and it's been mostly in the last 2 weeks, but it has literally exploded to the upside. Contrary to that, hopefully people were listening to the heeding the warranties, the warnings to be careful in real estate and utilities. So this actually draws the S&P as the average through the middle because it's depressed here. And when I toggle this, what will happen is it'll show the absolute gains of each sector over that same period of time. And what you see is both utilities and real estate have actually not only underperformed the S&P 500, but are negative over that period of time. So it's not that they've dropped dramatically, but again, it's the lost opportunity cost. Whereas if you were in healthcare or whatever, you're up 8%, and here you're down 2%. So your difference is about 10% to stay in those sectors through this time. Lots of reasons to stay in them, defensive, a ballast for an aggressive portfolio, lots of things like that. But what I want to point out here is that when we look just across the board, really discretionary hasn't done anything, and it's starting to perk up right now, which was one of the reasons I wanted to do this sector comparison. And then materials has, I think, been a surprise to the upside, 3%. Energy still lagging badly, and when we talk about working through the different charts here, I'll show you energy specifically, but it is clearly alone in its own space, behaving way differently than everything else. So it's quite interesting that the whole world thinks energy is just such a bad idea. Staples here is at 1%, and financials are up 5%. So those are really big numbers. Okay, I want to, well, let's do this first. Let's go over to the gallery view of these sectors. And so I'm going to go through them in the same order that they were on this page. So discretionary, commercial, communication services. And as we work through them, what we'll see here is here's discretionary, and you can see it's trying to break out of this range. This is the intraday. Here is the consumer discretionary. And it only has to go from 123 to 124 and a half to make new 52-week highs. So that's very close to pushing up there. And here you can see communication services broke out roughly a week and a half ago and continues to climb. The weekly chart on discretionary shows the tight range we're in here, and obviously an upside breakout would be very bullish. If we look at the XLC, what you'll see here is, doesn't look like much, but it's still pushing out the top end of the chart. One of the important things to consider is for me, is where the PPO is. And so in this case, I'll just explain this. So when you're rising and below zero, it's spring. When you're rising and above zero, it's summer. When you're falling above zero, it's fall. And when you're falling below zero, it's winter. And if we just use that simple terminology to kind of describe the market health, you can see that consumer discretionary is still in a fall position, but consumer or communication services is actually turned up now and is in the summer position, so above zero and rising. This is all very bullish, and again, we like to see this change in setup here, where consumer discretionary. If you think of retail, maybe from now till March is typically when the retail stocks do quite well. So it would be interesting to see if this is the new upthrust to start the move into discretionary. They have underperformed quite significantly, actually, compared to most others. Moving over into technology and the industrials, what we see here is, the industrials, quite frankly, have been meandering for the last couple of weeks. The technology still continues to look good. Nice big spurt on Monday, got up above last week's highs, and then has kind of consolidated since then. The chart looks very nice, continuing up and to the right, nothing wrong with that. And the same thing on XLI, up and to the right. And if we look at both of these stocks from a perspective, they're both in the summer position, up and rising well above zero. So very nice, positive place on the charts. The one thing I like about this technology is it's outperforming the S&P 500. We don't quite have that with the industrials yet, and we'd like to get this big upslope going in relative strength. So hopefully we can it looks to me like we're trying to break this downtrend, and if we could start to actually have the industrials outperform, that would be very bullish. Okay, let's get over into the XLB and XLE. And what I want to show here is, they've been meandering for 2 weeks. They haven't really done anything great. But look at this XLB chart. It broke out, we call it November 1st, and it's run up, and it's holding okay. If you look at the energy sector, it's still below its 200-day moving average. Oil's at 58.50, and yet the energy sector just can't get a bid. So that was one of the reasons I want to highlight this today. I'll show you some interesting charts that I think might be a reason to at least tilt your head towards energy, even if you choose not to buy it, but you'll be aware of what's going on there. XLB, what we see is it's moved up into the summer position here, and energy is in the spring position. The one thing I like about energy is it's broken this big downtrend line in momentum, and usually that's been a nice place to start looking into some areas. So I don't really want to see this full stochastic continue to roll over. I'd like to see it kind of turn and go higher here. And if I started to get that signal, that would be a very bullish one for me. Looking at XLB, you can see it's still below the January highs of 2018, but very close to it, 60.81, 61.96. So it's only got $1 to go, and it would be at new 52-week highs. Energy, on the other hand, still has to go up almost 20% to get back to last year's highs. So quite a dramatic underperformance by energy, and by far one of the worst sectors in the market. And I'm not sure why this chart is like it is. So let's just go create a new one. Gallery view, XLP and XLV. Go would be good. That's very weird. I am not sure. Okay, maybe I'll just go grab a new tab here. XLU and XLV. That's better. Okay, let's take that and just slide it over here. Actually, it was supposed to be XLP, so let's do that. Okay, there we go. So here's XLP, and you can see we're trying to test last week's highs. No big deal. Healthcare's been on a crazy run. It's been absolutely ballistic since moving up real rough end of October, call it October 25th or so, and really starting a big mammoth run. On the other hand, XLP has been grinding sideways and just started to make a new 52-week high again here this week. So it's pushing up nicely. One thing that's a huge change is if you'll notice the scooter ranking on XLP, notice how it stayed above 75 almost this whole time. XLV was doing the opposite. It was below. Now they've reversed. So this is quite clear. XLV is quite an outperformer, and if you compare that to XLP, it's quite an underperformer. When we go back and look, XLP spent like 2 years in the jungle or down here in the lower part of the relative performance, and then all of a sudden, over the last year and a half, it's been one of the better sectors of the market, and I think we all know that. But the main point is this scooter makes it quite obvious that there's been a change in sentiment here, and all of a sudden healthcare's really rocketing up. Now the real question, how long can it keep going? One of the things I would say is healthcare is clearly in the summer position, accelerating higher, and the consumer staples is in the fall position where it's declining well above zero. And I don't want to make it sound like it's declining hard, because obviously it's hitting new 52-week highs right now. Just in terms of momentum, it has slower momentum than it had when it was in this big uptrend here. So the full stochastic still staying above this 80% level. It looks very, very solid. But when the market moves hard into these growthier stocks, what we see is this kind of pullback away from this one particular industry group and jumping into the other. If we look at, I'm really befuddled by why all of a sudden these started to leave me. So I'm just going to go get the next two. It's going to be XLU and XLF. And what we see here is for the XLU just grinding sideways for the last 2 weeks. XLF made a new all-time high here, breaking out really nice. And on XLU, you can see it's pulling back. And again, the same sort of scooter ranking change where XLU has been the top performer all through here, and then all of a sudden now has the weakest scooter ranking that we can see, since April. And XLF has been, I'll call it meandering, but still not in a bad area. But now all of a sudden, it spent the last 6 weeks as one of the top performers, basically since JP Morgan reported on the 15th, and we've been going higher since then. From the weekly perspective, what we see here is XLU once again is now in the fall position, and full stochastic pulling back to the 50 level. It doesn't drop much below that, which is quite interesting. And we had the big pullback at the end of 2016 and the early 2018 pullback, and it's been pretty much bull market conditions since then for the utility. So we'll continue to watch that and just see if it wants to start to turn back up again here. Looking over at the XLF, clearly a breakout to new highs. Scooter ranking is now behaving better than it has all the way back until March of 2018. So this is quite clearly a trend change. And you can see, really nice chart shape on this as it starts to break to higher ground. The last one I want to show is XLRE, the real estate ETF. And it is doing the same thing on the scooter ranking. See how it was absolutely pinned to the top and now it's dropped down? And we see that going back over a year, the XLRE was the top performing area. And literally a light switch went off and this has changed. So if we drew a line just at 50% on here, just go down here. And the way to do that is you want to overlay. We're going to pick horizontal line. We're going to put the level of 50 and we're going to make it blue. Could make it black, could make it whatever, but that gives us this line, and you could just see in favor it was the top performer, out of favor for almost 2 years, and then back in favor for 15 months, and now very clearly a sharp move to the other side of the ledger. So to me, this chart is telling us to be aware of the changes in the bond market. It looks to be a significant change according to the XLRE investors. And we also saw it in the consumer staples and in the utility. So all of this looks quite bullish for the overall market. We're going to take a quick break here. And when we come back, I'm going to cover energy more specifically and jump into that and a little bit on the precious metal. So stay with me. We'll be right back. We're back, and we're going to go into the energy charts now. I think this is almost a dramatic change in events here. Looking at the different types of energy, I've got oil. So this is U.S. oil, West Texas crude. This is Brent crude, so really the world price of crude or the European price of crude. Then there's a Middle Eastern and a Singapore. There's a few different ones, but if we just pick these two different ones, one is the U.S. price and one is Brent crude. And even Brent crude being so close to the Middle East has actually been down more than the U.S. price of crude has been over this 47 days. And you can see it's September 23rd. And if I change this to 49, I think takes me to September 19th. So that was the weekend before oil jumped up on September 21st. And then pulled all the way back. So these oil attacks here, what we're seeing is really unchanged since that happened. And as I mentioned, we've had a massive, at minimum, 120 million barrels a day of production affected, and probably, even if you pick the center of the range, say 3 million barrels a day, you're looking at something in the order of 180 million or 200 million barrels of oil that hasn't been produced and put into storage. And you would think that would tighten up inventory. Well, it doesn't seem to have changed squat. So that is quite a surprise to me. I found that to be not remarkable, but surprising that it didn't seem to matter that much. Now, I want to show you one chart. This is from 9 Point, which is a Canadian investing fund, like a hedge fund. And what we see on this chart is this is the E&P stocks, so exploration and production stocks versus West Texas crude oil year-to-date price change. So crude is actually relatively flat on the year. And then if we go look here, well, actually it shows crude up 29% from Jan 1. And then, but there's only 4 or 5 stocks, and most of these are Canadian, and that's because they were beaten down so badly last year. But just look at some of these profiles on these stocks. A lot of these are Canadian names, but here's Devon US. You can see, flat on the year. But the change here's Fang, Diamond Exploration, down 20%. These are big numbers. And when you look just at the drop, I think it's surprising that oil could be up this much. And to see this big energy slide. Now, I want to talk about oil, of course, jumped up quite a bit right at the early part of January. So let's just go get that chart. I'm going to put in $ WTIC, and we're going to select year to date. So it's this big bounce here, right? So oil kind of bounced up hard, but you can see for the most part, we've been trading in the same range. Here's the Saudi oil spike. They haven't really made any significant progress. But the one thing that I would say, if we go to a weekly chart on oil, is, our PPO is just about ready to move into positive territory. For me, that's a big deal. The full stochastic is moving above 50 for the first time in 4 or 5 months. So even after the Saudi strike, it didn't last long enough to push us up above. And when we look at this, the one thing I'm going to just shorten this chart to 2 years. Yeah, that's probably enough. What I want to show you here is on my momentum indicator on the PPO. It's relatively flat here, but I just want to show that This is kind of the area that if we were going to maintain the same sort of downward projection in oil, we're at that point where it should roll over right now, where we should start to see it break out. And we're right at the zero level. So again, from that fall, spring perspective, we're in spring where we're rising above zero. And now the real question is, do we have enough energy here to push this chart right up and break out to the top side? I don't know if we do. We're about to find out. But again, the XLE is down 20% on the year. Crude oil, if you whatever pick it from this level, if you pick it from a few weeks later, it's a lot different. But it's this bounce off the bottom. Just think about how much all the other stocks have bounced, and yet the energy stocks are just getting crushed. So watching to see if this all of a sudden starts to turn higher. We're breaking above the range that oil was in before the Saudi spike. And so this is a really interesting inflection point. Anyway, if this market is going to continue to broaden out, this is one of the areas that I want to look for a possible upside reversal, and we start to see some really nice moves in that. So I'll be covering that off over the next few weeks as things start to change. But I don't want to forget about this energy area, and the main reason being just because it's been such an underperformer, and yet the chart is actually looking relatively bullish, and a move above zero would all of a sudden suggest an upward thrust, and perhaps we can get energy stocks to start to participate on that. So that in itself seems bullish to me. Now, if I just show you the XOP chart here, so keep your eye just how we're roughly in the middle of the range here. If I go to XOP, the exploration and production chart, you can see that this has just been a nightmare. So $44 was October of last year, and remember, everything fell into December. Well, this chart has taken out the December lows long ago. Here's the Saudi oil spike, and we still haven't been able to get any sort of real traction to the upside here. So we're sitting down around the lows. And if I open this chart up to whatever, 20 years, you'll see the devastation that we're seeing here. We're right down here at new 20-year lows. Well, it only goes back to 13 years, but we're at the lows going over this long period, even though oil's at $58. Remembering in 2016, oil got down to $26. So here we have oil at double the price, and yet the energy stocks are even lower than they were then. Really an odd situation for me to try and understand why the energy stocks are so unloved. One of the reasons is in the Permian, or in the shale basins, we're starting to see a lot of withdrawal. Companies aren't able to keep their drilling rates going at a Fibonacci sort of rate of growth. So one well, then two wells, just to keep up with the decline rates on the first two. Then you need to drill 3 to keep up with the decline rates on the previous wells. Then you need to drill 5 to keep up with the decline rates. So you end up with this accelerating number of wells that you have to keep drilling every year to stay on the treadmill and show positive growth in your production. Because these shale wells come on really quick and then drop really fast and have very quick depletion rates, or go from, say, 1,000 barrels a day to 20, 30, 50 barrels a day. They do that relatively quick. So you get payback for drilling the well, but you're not actually kind of building out any sort of long-term growth profile for the company. So that's starting to show up in these stocks. And I think the real question that we want to watch for is, does the price of oil all of a sudden start to turn and rejuvenate the sector? And do we start to see some of these stocks break out to the upside? So that's one of the areas that I want to look at most closely. I think that's a big opportunity heading into the fourth quarter, and perhaps, or not the fourth quarter, December, and then heading into the first quarter of 2019. I'm reminded when Shell had a fire at their oil sands facility when it first opened in 1999. They opened it just before the calendar year end, and then on January 7th they had a fire. And the fire, the announcement was, we've had a small fire. And I was told by an accountant at the time, there's no such thing as a fire, and oil business. So anytime you have those 3 words in combination, it's always bigger than you expected, and it's never good that you've had a fire at a refining complex or a production facility. and how long it takes to repair that is a meaningful question. So the Saudi situation now, let's just say it's at least taken 120 million barrels a day out of production, and perhaps, you know, all the way up into the 300 level. If that takes another year or 6 months to fix, let's just say next summer, to get all of that oil back on track, how much spare inventory do we have? Well, worldwide, we had about 130 million barrels in inventory, and we've only slowed the flow into that by roughly 2 million barrels a day, and Saudi's been able to make that up from some of their other fields. So the real question is, as we come through this high usage period of winter, will we have enough oil inventory, and how tight does it get before that crude oil production comes back on in Saudi? I think it's an interesting area to watch, and if you're looking for something to kind of get some spark, it might be the oil sector that might show up. Okay, just a few minutes left, and I want to cover off gold and silver very quickly. Gold had an outside reversal day yesterday. Maybe I should just show that on a chart. So GLD will work, and let's just go to a daily view. And what you see here on the chart was we had this big downtrend for the last few days, and then gold had literally a big outside reversal, and today it's just hovering back at where it was the day before. So watching to see if all of a sudden, you know, what was it that kind of caused this spur, and will this start to run to the upside? So again, gold has been flagging, if you will. So this is your pole, this is your flag, and now the expectation would be at some point it starts to break back up and turn around. And there's been some great names in there, some silver names starting to produce. So when we look at this chart of gold, we'll see over the last month, gold is down 3%, silver down 5%, platinum down 2%, palladium down up 2%, and copper flat. So continuing to watch this precious metal space. And what I want to see, like if we take this to whatever 90 day and 3 calendar months, yeah, there we go, 3 calendar months, so roughly 60 days of trading, you can see that gold is off 6% after having an absolutely spurious run from May to the end of July. And now it's been quietly pulling back. Silver's down harder over that period. If we take this slider and just move it back to the end of July, there, something like that, we had a better run in gold. And I'm just going to change this to the end of May. Move the whole thing, sorry. Just get this set. There we go. End of July. So roughly in this May timeframe, gold was up 10%, silver was up 10%, palladium really had rocketed up. But we saw the energy stocks really take off. So if I put GDX up here, sorry, not the energy stocks, the gold mining stocks. Keeps moving me around. I'm sorry about that. Slide this back. There we go, July. You can see the big move that we had in the gold miners. And it's that type of change that I want to follow and make sure that we're on board with watching. So if gold can start to reverse here, that might be something to look at into the December season, as well as energy, for the reasons I mentioned. The consumer discretionary also looks like it's ready to break out, so try and focus on that one as well. Thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific time on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. Thanks, everybody. Have a good Thanksgiving. Bye-bye.